Hey tax students, this is your teacher Roy with a review video for last semester's tax class. Our current semester is Accounting 137, Business Income Tax Preparation. But last semester's Accounting 134, that class was for individual income tax prep. So probably the best way to review last semester's tax class is to take a look at, of course, the tax return or tax forms. Always making sure you have the correct year version. So for example, if you're preparing a 2022 tax return late, like right now, you wouldn't use the available 2023 return. You have to go back and dig out an older version, the correct year version 2022. Also, if you've already filed a prior year tax return but want to change what's on the return, at least within the 3 years since you filed the return, you can't use that regular 1040 year version. You have to use a version called 1040X. 1040X is the amended format, for any of the amendable open tax years. But let's focus on 2023. Here at the top, you probably would leave this date blank, empty, because you're filing based upon the 2023 calendar year. I've never seen an individual not have a calendar year. But later on in this current semester, we'll prepare partnership and corporate returns that may have, it is common to have year ends other than December 31st. And for those types of business entities, you would probably fill in the dates here for a so-called fiscal year. So we have the names of the taxpayer and their social security numbers. If you're not familiar with a new taxpayer you're working with, make sure you have the correct name and social security number that's on file with the IRS, on file with the Social Security Administration, basically by looking at their social security cards or some type of document from the Social Security Administration showing their name and number on file. And that's also true for any dependents you're listing down on that return. Again, their name and correct social security number. If you're one letter off, one digit off in their social security number, and you electronically file the return, automatically the return is going to be rejected. Okay, so make sure you're accurate. And from then on, for future years, probably the software you're using will carry over the name, correct name and number. The home address here doesn't have to be physically the residence, but could be a PO box number. But this is the official address the IRS is going to use for any correspondence with the taxpayer. Included any paper refund check mailed to the taxpayer. Of course, taxpayers usually want their refund fast, so it's going to be direct deposited into their bank account if they give that information at the bottom of this 1040 form. Here, this presidential election campaign checkbox, it doesn't matter if you check it off or not. It's not going to increase or decrease the refund or the tax due. One of the main things we learned last semester was a taxpayer's filing status. These five different check boxes were listed here at the top of the form last year for 2022. Filing status is important because it'll eventually determine the amount of standard deduction that can be subtracted here in line 12. Here off in the margin, you can see some basic general dollar amounts for standard deduction based upon the taxpayer's filing status. Another thing that the filing status will determine is the tax rates applied to this taxable income. If you checked off married, filing, joint, or surviving spouse, the name is qualifying surviving spouse. Those types of filing statuses, more of their taxable income gets taxed at lower tax rates, lower percentages than the other filing statuses. Okay, so a filing status is important to make sure you qualify for the one that helps the taxpayer the best. Digital assets, this question has been on the form for the past few years. Basically, if you receive cryptocurrency or some type of digital asset like Bitcoin for compensation for doing work, for selling merchandise, that's going to be taxable. Even if you redeem that type of digital asset, sell it, or even exchange it for something else, not even receiving cash, it's still a taxable transaction. Possibly need to calculate out a capital gain or loss. For standard deductions, if you're being claimed as a dependent, you, the taxpayer up here, and you are also being claimed as a dependent on somebody else's return, the amount of the standard deduction you can claim is not going to be one of these general amounts listed down here in the margin. Yeah, you're going to have to use the worksheet in the 1040 instructions to calculate out the standard deduction for a dependent. If you were age 65 or older or legally blind, then you get an additional standard deduction tacked on to the general amount listed below. So the income types, the most common types are listed here on the 1040 form. And of course, the most common type here in line 1A is wage or salary income reported to the taxpayer on Form W-2, in addition to whatever taxes were withheld. So you add up all the box ones from the different W-2s, and the total would go here in line 1A of the 1040 form. But as you can see, there's other types of wage income that may be added in here. Not too common, but let's go through a few of these here. If you work as a household employee, like doing house cleaning or maid or gardening work, even babysitting, all at the employer's home, then the employer should be issuing out a Form W-2, just like a regular employer, if the amount is more than $2,000 or $3,000 for the year. But if the amount is less than those amounts, the employer is not required to issue out a W-2 form, but the income is still taxable. You got to report here. Tip income, if it's handled correctly, should be reported to the employer so the employer can include it on the W-2 form and withhold the proper amount of taxes. But if the tip income was not reported to the employer, or you have something called imputed tips, those amounts have to be added in here, added to the other wages. Okay. Medicaid waiver payments usually are not taxable. Same thing with combat pay for armed service personnel. They're generally not taxable, but the taxpayer can elect to add it in, here. Now, why would the taxpayer do that? Well, maybe then this type of income will help them qualify for more tax credits to offset any income based upon this elected income to be included here. Okay, so that's more employer income. If you have some benefits from the employer, like dependent care and adoption benefits, and you get a distribution but don't use it for qualifying costs, it's probably going to be taxable over here. Okay, so total up all of this miscellaneous wage income, line 1Z. Then next we have another common type of income for interest and for dividend. And if these amounts exceed 1,500 for the year, each of these, then you have to report it first on a Schedule B, If you don't have 1,500 or more than 1,500, you still have to total up your taxable interest and taxable ordinary dividends here. But let's take a look at Schedule B. Schedule B, where Part 1 is for interest income, and below Part 2 would be for dividend income. You write in the name of the financial institution and the dollar amount, yeah? The name of the paying institution and the dollar amount. Typically, this will be reported to the taxpayer on Form 1099, original issue discount or regular interest, INT. If the amount is less than $10, the bank or financial institution is not required to issue out a 1099, but it's still taxable. You got to write it out. Then you take a subtotal here in the next line, line 3. If one of the interests you have up here is coming from a federal U.S. savings bond, yeah, EE or I bond, and you redeem it that year, report the interest. And also in the same year, you have qualifying education costs, and your income is within a certain dollar limit. You may be able to exclude that federal interest, the EE or I savings bond. I've never seen this in my whole life. There's probably better ways to save for education than through savings bonds. We take a subtotal here and you would write the subtotal back on the 1040 form. Since we're here already on Schedule B, let's take a look at this part 2 for ordinary dividend. So you write the name of the corporation and then the dollar amount, the name of the exchange traded fund possibly, and the dollar amount of so-called ordinary dividends, which are reported to the taxpayer on Form 1099 DIV. And then we take a subtotal for the ordinary dividends. We take a subtotal for the taxable interest. And we rewrite it here in the taxable column for interest for ordinary dividends. Now notice off to the left side. Here is for tax-free, tax-exempt interest. Even though it's tax-free, you still have to report it here. And it's not going to be added into the other taxable income here. But it may affect, this tax-free interest may affect the amount of Social Security benefits reported in line 6A that eventually will be turned into taxable. Okay, so this Social Security benefits, this amount right here, the gross benefits for the year, are reported to the taxpayer on Form SSA 1099. And that form is not going to tell you how much is taxable. The amount of this gross Social Security benefits that are taxable are based upon the total other income of the taxpayer. And you'll turn the gross benefits up to 85% to be taxable. If probably the only thing you receive during the year is Social Security benefits and no other income, probably this will be zero taxable. But if you have a moderate amount of other income, they'll turn this Social Security benefits up to 85% of it as taxable. Now, if you have tax-exempt interest, yeah, you don't pay taxes on it because this is coming usually from municipal government bonds, state government, city, county government bonds. But it may turn your Social Security benefits into being taxable. So you gotta use the worksheet for the instructions of the 1040 form to calculate out this Social Security benefits that are taxable. Here, this next line below, off to the left side, is qualified dividends, which are already included in the ordinary dividend figure we had entered back on Schedule B. So you're not going to add this number in again because it's already here in the ordinary dividend number, the total. But when you come down all the way to the total taxable income here at the bottom, what you're going to do is you're going to back out this qualified dividend number here. Okay, it's already inside of here, yeah, because it's inside of the ordinary dividend. But the qualified dividends are going to be backed out and taxed at a lower rate. Could be tax-free, could be 15 or 20%, depending upon the total other income of the taxpayer. Another type of income that gets taxed at lower rates is long-term capital gains. So maybe in addition to dividend income, you receive something called capital gain distributions, probably also reported on that same form 1099 DIV. And you may need to check off this box here and add in the long-term capital gains or the capital gain distributions. And just like the qualified dividends, capital gain distributions gets taxed at lower rates. So you're going to back it out of here and tax it at that 0, 15, or 20%. And the rest of the taxable income gets taxed at regular higher rates. Talking about capital gains. So in addition to capital gain distributions, if you sell other investments, if you sell other capital assets, you probably have to prepare a Schedule D. And those numbers are being fed by another form called 8949 for all the different sales you've made during the year that can trigger capital gains or possibly capital losses. And then if you have so-called long-term assets held more than a year before you sell it, at a gain, again, those gains get taxed at those lower tax rates. If you end up with a total overall loss, capital losses up to $3,000 of losses can be deducted over here to offset other income you're reporting. If you have more than $3,000 of capital losses, then those losses can be carried over to future years to offset future years' capital gains, or possibly another up to $3,000 deduction here to offset other types of income. So if you don't see listed here the common types of income, maybe the income should now be reported on a schedule number 1. Also on schedule number 1 are a type of deductions called adjustments deducted over here. So let's take a look at a schedule number 1. Again, the first part is for some miscellaneous types of income. And I believe on the back side is the miscellaneous types of deductions called adjustments to income. Just a few, let's go through. Let's say that you receive a state income tax refund. You're going to get a form 1099-G from the government, state government, telling you how much you receive refund for the year. Typically, the refund you receive for the year is based upon too much taxes being paid in the previous year. Okay, so you're going to enter the amount of refund here only if in the previous year, in this case it would be 2022, you had claimed itemized deductions. You deducted state taxes on your tax return. But now because you paid too much state taxes, in the following year, 2023, you received a refund documented by that 1099-G form. Now you're going to report that refund here. Now, if you never itemized in the previous year, claimed itemized deductions, you took the standard deduction, but you still got a refund, state refund, that refund is not taxable because you didn't get any benefit of deducting the state taxes in the previous year. Now, can you tell me why federal tax refunds are not taxable? You don't put it here. The reason why is because you never deducted the federal income taxes. You claim it possibly as a credit to offset the tax, but you never claimed it as a deduction. So when you get that refund, you're not going to claim it as a benefit of a refund. Okay, there may be other limitations in the amount you put here based upon what you call tax benefit. Yeah, you may have to go through a worksheet that's inside the instructions for the 1040 form. But for most people who claimed standard deduction in the previous year, in this case 2022, and receive a refund here in 2023, nothing to report. Yeah, zero here. Alimony, we mentioned the year involved is, I think, 2018. Was 2018 or after 2018? Before 2019, if you got divorced and are still receiving alimony now, here in 2023, taxable. Now, if you receive alimony from a divorce that took place after 2018, not taxable. Likewise, if you pay alimony and the divorce took place before 2019, 2018 or earlier, I think I'm getting the 2 years kind of mixed up, 2018 and 19, but the earlier of that period, and you pay alimony now in the current year, you get to deduct it, subtract it. If you pay alimony for a divorce that took place after 2018, not deductible. Yeah. Okay, so that's the year you have to take a look at. And of course, if you got divorced way back then and still are receiving or pay alimony, you pretty much know whether it's going to be taxable or deductible. But if you got divorced now, you just ignore alimony for tax purposes. We'll learn about this business gain or losses later on in this semester. So if you're a landlord collecting rent, you may need to report your rental operations on this Schedule E, and we'll learn about this in a future chapter. Or a partner in a partnership, or a shareholder in a type of corporation called a S corporation, or beneficiary of a trust. And if these business entities earn income or incur expenses, they may need to tell that to the owners, the partners of a partnership, the shareholders of a S corporation, beneficiaries of a trust. You may receive a schedule called K1, and you're going to report your share of the income here and possibly other places in your own tax return. We'll learn about partnerships and corporations in a future chapter this semester. Farm income, pretty much like business income that we're going to learn in our next chapter, next week, preparing a Schedule C. For farms, you have to prepare a Schedule F. The accounting reporting of income and deductions could be slightly different than other businesses. You got laid off, you're unemployed, and are receiving unemployment pay. The government is going to issue a 1099-G, just like this refund here, yeah, but on a different 1099-G for unemployment. All taxable. Got to report here in line 7. If you have a business loss, let's say up here on a Schedule C, and there's limitations on how much you can deduct, the unused deduction can be carried over to a future year, claimed as a NOL, net operating loss deduction. And you can see the brackets here already to subtract out. Gambling winnings, the gross gambling winnings for the year has to be reported here, total for the whole year. You don't reduce this figure by any gambling losses for the year. If you do have gambling losses, those can be deducted as itemized deductions on Schedule A. But if you claim standard deduction, then you can't deduct any of those losses. Yeah, again, the gross gambling winnings reported here. You borrowed money, and the creditor tells you, we're going to cancel it. Okay? We're going to forgive you of that debt. Well, that's good for you, but that canceled debt is taxable. You need to be what they call solvent to make it taxable. So if you're insolvent, if you still owe more than what you owe after this debt is canceled, possibly the canceled debt is not taxable. Okay, so you need to go through some calculations on the financial status of the taxpayer to determine whether the canceled debt is taxable or not. If you work outside of the U.S., work meaning earned income, yeah, and possibly that income is subject to taxes in another country, you can exclude on your U.S. income tax return up to $100-something thousand here, yeah, tax free. But again, you have to be working outside of the country. You cannot be also working for the U.S. government, even though you're working outside of the country. So some private company you're working for outside of the U.S. Working outside of physically the U.S. You could be working for a U.S. company, but again, it's outside of the U.S. Jury duty pay, taxable. Prizes and awards, you're probably going to get a Form 1099 miscellaneous, MISC. And even if you don't get a form, because it's below the reporting limit of 600, it's still taxable. You add it in here. Here's your hobby income, gross hobby income. You're not going to treat it like a Schedule C business up here because you can't take any deductions here in this line J. This is the gross income. Possible hobby expenses could be deductible, but as itemized deductions. And again, most people don't claim it because they claim the standard deduction. Let's see. Scholarships and grants. Maybe you're getting a scholarship and you didn't use it for qualifying education costs. For example, room and board. Scholarship for room and board, taxable over here. Okay, then subtotal, reported back on the 1040 form. Let's see what deductions are in the back here. Again, these deductions are called adjustments. Don't confuse them with itemized deductions. If you're a pre-K to 12 teacher, up to $300 per year classroom costs could be deductible. Health savings account contributions are not common here in Hawaii because to be able to have this type of account, to make contributions and deduct for health savings account, you have to be covered with a high deductible health insurance plan. And most people here in Hawaii get their health insurance from their employer, from Medicare, Medicaid, TRICARE, all have low deductible health insurance coverage. So they cannot put any money, they cannot deduct any health savings account contributions. Moving expenses, only deductible by armed forces personnel if the government doesn't cover it. Yeah? We'll learn this semester self-employment income, and you're going to pay Social Security and Medicare taxes. Because it's such a big hit, half of it will be deductible here. And also contributions to a self-employed retirement plan and payments of health insurance for self-employed taxpayers could be deducted over here. If you have a certificate of deposit with a bank and have to withdraw the money out early, you get penalized, not by the government, but by the bank, and it's a deduction here. We already talked about alimony, IRA contributions. This is deductions for contributions into a traditional, not a Roth type, yeah, but a traditional. And there may be limitations for taxpayers who also at the same time are participating in their employer retirement plan. Payment of student loan interest, deductible up to $2,500, and it may get phased out based upon higher income limits. Let's see. Let's take a subtotal here at the bottom. So this subtotal for adjustments and this subtotal for other incomes is then reported back on the 1040 form. Added in here, other miscellaneous income, and subtracted here for adjustment deductions to get to our infamous adjusted gross income amount, which may affect items up here as income or deductions down here as itemized deductions or tax credits. It's always best to try to reduce this number as much as possible because not just because it's going to reduce the income, taxable income here, but it's going to affect positively other numbers on the tax return. We'll learn about QBI, Qualified Business Income Deductions, in our next chapter of the semester when we cover Schedule C's. So, okay, so we get to taxable income. This is our tax base. And if it's under $100,000, we learned in Chapter 1, you have to use the tax tables. You know, those pages and pages of numbers in the 1040 form. If it's 100,000 or more, you use the tax rate schedule. So ultimately coming out with the total income tax liability for the year, here called taxes. Again, this is for the whole year. There may be other taxes that's tacked on to the income tax, first reported on this schedule number 2. One of them being that self-employment tax I had mentioned before. Okay, we'll see in our chapter 3. Then we get to reduce the tax by credits. So there's 2 bunches of credits. One bunch is up here called non-refundable and can only be used to the extent of any tax up here. So if you have excess credits here, more than the tax, the excess credits are usually wasted. And then down here are the better types of credits called refundable credits. So if you have extra credits here, more than the taxes above, the extra credits can be refunded to you. Now, one of the non-refundable credits is so-called child tax credit. That's the $2,000 per qualifying child versus the $500 other relative dependent credit. If you cannot use all of this child tax credit, maybe part of it is moved down here and turned into a refundable credit called additional child tax credit. That's calculated on this Schedule 8812. Same thing with the child tax and other dependent credit. Yeah, Schedule 8812. Some other credits. Let's take a look at this Schedule 3, the non-refundable and the refundable type. Yeah, Schedule 3. Non-refundable type here in Part 1, page 1, and refundable type back in the next page. So we learned a little bit about foreign tax credits last semester. Your income is subject to both the U.S. income taxes and also a foreign government tax. So to prevent from being double taxed, the U.S. government will give you a credit for the foreign taxes you paid. There are limitations, and that's calculated on this Form 1116. So you need to take care of your dependents, your kids, so you can go to work. Yeah, there's a credit, not to be confused with the child tax credit, but this one called child and dependent care. Yeah, taking care of your kids' credit, calculated on this form, 2441. Maybe you qualify for this credit as a college student. Education credits, yeah, plural. There's both the lifetime learning credit and the American Opportunities Credit calculated on this form 8863. The lifetime learning credit is non-refundable. Some of the American Opportunities Credit is non-refundable. Some of the American Opportunity Credit is refundable, also calculated on this 8863 form and reported directly on the 1040 form, bypassing this Schedule 3. Maybe you're already saving for retirement. Yeah, that's the efficient ways to go through your employer's retirement plan, or save on your own with an individual retirement account. So you get tax benefits there, reducing possibly your income. But also, if your income is relatively modest, low income, the government will give you not also a deduction, but a credit calculated on this form 8880. What's becoming more and more popular is those photovoltaic systems, yeah, photovoltaic, solar water heaters, even things like heat pumps, efficient windows, energy efficient, and the government will give you a credit calculated on this form. Even now, more recently, the electric vehicle credit. Yeah? There's a certain order. This is the order you take credits. Yeah? Use this one, then this one, and so forth, going down the list. And take a subtotal here at the bottom. This is your so-called non-refundable type. Can be used only to the extent of the taxes you have for the year. Any excess, possibly wasted, some may be carried over to future years. And then the backside are the refundable types. So let's say you have health insurance, and if you qualify, you can go through the government exchange where you can buy what they call Obamacare and get a premium tax credit to help you pay for that insurance. You have to reconcile how much you got of subsidies during the year on this form. So if you have extra coming to you, it gets back as a refund. Possibly maybe you use too much credit and you have to pay back that excess. Let's see. If you have more than one employer for the year, maybe they took out too much Social Security tax. The employer is not going to pay you back, but here you can claim that excess withheld as a credit. Okay, some other miscellaneous. So subtotal, refundable credits or payments, and we carry that back again to the 1040 form, either here as non-refundable or here as refundable. So the bottom line is maybe you overpaid for the year. So for most of us, we want that back as a refund, and we want it back fast. So here, direct deposit information going straight to my bank account, hopefully within a couple weeks. For those of us who are self-employed, we don't have an employer to withhold taxes. So we got to pay taxes, not after the year is over, but during the year, called estimated taxes. So instead of getting back a refund, maybe we'll apply the overpayment to next year's estimated taxes. And of course, if you owe something for the whole year, here's a balance due. And if it's more than $1,000, generally you get penalized. Yeah, so that you gotta make sure you have enough taxes withheld, not by the end of the year, but during the year. Same thing if you have to pay taxes on your own during the year because you're self-employed or you have miscellaneous investment income. So let's stop here. Um, so in the coming weeks, we'll learn new topics beginning with chapter 3. Okay, I'll talk to you later.